Welcome back to Focus on the Future. 2 weeks ago, we presented a program about buying a vehicle and how to make sure you are properly prepared before walking into a car dealership. Today, we're going to take a look at the next and final step in the vehicle buying process, the finance office, where you close the deal you've made. This is where a final check of your credit score will occur and your exact monthly payment for the vehicle you purchased will be calculated. You'll sign what seems like a mountain of paperwork and drive out with your new vehicle. This is an experience that can sometimes be daunting and somewhat intimidating if you're not prepared. So this week, we're going to talk with our guest, Jackie Siddon, finance manager for one of the nation's leading Ford dealers. Jackie will give us the tools that we need to better understand the closing process. Welcome to Focus on the Future, Jackie. Great to see you.
Thank you, Skip.
Thanks for having us here today.
Absolutely.
Let me start with just a basic question. Tell us about yourself and what does a finance manager do?
Well, my name's Jackie Siddon. I've worked for Don Chalmers for about 5 years now, 4.5 years. I've actually worked with Ford dealerships off and on for almost 28 years. Been in finance for about 20 of those 28 years. And as a finance manager, I am one that actually deals with a customer one-on-one with obtaining information about them, about their past history, and trying to help them finance a vehicle.
Okay, so let me understand this. I've been out on the dealership floor. I've picked up the vehicle I want. I've talked with the salesperson. My credit's been already checked, obviously. So I have a rough idea of what, in fact, I've made a deal. The salesman's agreed to it. Do you see the deal before I walk in here? Do you know that that deal's already been made?
Yes.
Okay.
Yes.
So there's no mystery to that.
There's no mystery at all.
Okay. So your function then is to help me make sure that I can afford this vehicle?
That's correct.
Okay. And you base that decision on what?
Income, past payment history. If we're talking about a first-time buyer specifically, you know, the bank wants to make sure that everything's in line as far as payment to income.
Okay.
Normally, that's an average of about 15% of their gross monthly income before taxes.
Okay, you mentioned something about a first-time buyers program.
Yes.
I know that Ford has a really great first-time buyers
They
program.
have the best.
Can you, you better think it's the best. Can you kind of outline that for us a little bit?
Yes. Ford's first-time buyer consists of someone that's actually has no credit or no collections, no derogatory credit.
Okay.
They've, you know, in college, some students, or in high school, some students actually, even in high school, have established credit cards or are authorized signers on their parents' credit card accounts. First-time buyers consist of someone with no previous car credit history.
Okay, so it's not necessarily important then that I have any credit history at all. It could be that I'm fresh out of school, 6 months out, and you know when you pull up a credit report of an individual like that, I guess you get a 999, don't you?
Actually, it's just a 0. There's no credit score showing.
Okay.
No, what's called what is called actually a beacon score. There's no beacon score showing.
I was just trying to give Herman Cain a little endorsement.
999. Ford's first-time buyer consists of someone that's fresh out of school, has again no derogatory credit, no credit at all, compared to no derogatory credit, preferably.
Okay.
15% payment to income.
Explain that.
15% payment to income, whatever the gross monthly income is before taxes.
Right.
Ford prefers that they have no more than a 15% of that amount for their payment.
Okay, so if I'm making $1,500 a month, my payment could be roughly $225.
Correct.
Okay.
That is correct.
All right. So and not over that limit. Is there any flexibility in that?
Usually maybe $5-10 a month max.
That's about it.
Yes.
Okay. When you say derogatory on a credit, I can have no credit score, but I could have some derogatories, correct?
That's correct.
What would those be typically?
You know, normally student loan gone bad, you know, a credit card charge off, a insufficient check that's showing up on your credit that they've charged off.
Okay. Those are typical things that happen to a lot of folks.
That's
so
correct.
Pretty much you better do your homework before you walk into this office so that there aren't any surprises.
That's right.
I don't know about you, but I don't like surprises. I like birthday surprises and holiday surprises, but that's it.
That's correct.
And the rest of it I don't want any part of. So you do your homework first, make sure you know what your credit score looks like, make sure there are no derogatories before you ever try to go through that process, because otherwise you're going to get shot down, correct?
Smart thing to do.
Well, it seems to me. Now, most folks don't qualify for a first-time car buyer's program. Typical car buyer walks into your office. What do you look for in terms of qualification before you can make a deal?
Again, no derogatory. Preferably if they do have credit that they've paid on time, of course.
Right.
You know, if it's a college student or someone that's just graduated, that's a big program that Ford Motor Credit has, because Ford Credit knows that person's trying to establish themselves. They actually have rebates available to those college students or college grads in the amount of $500.
Great.
And great interest rates that are available.
Right.
You know, as low as 4.9%.
Really?
So,
pretty good indeed.
Yes.
Now, an individual walks in and they have a credit score of 650. Now, credit scores, as we know, run from 350 to 850, right in that range?
Yes.
So 650 is right in the middle of the target, basically.
national average, actually.
Is it really?
Yes.
I'll be darned. Is that person a qualified buyer at the highest or lowest interest rate, I should say?
Again,
Or
it depends on what credit they have, Skip. If
the
they
score
have
doesn't
any.
necessarily drive it?
No, well, with the credit unions, yes, but when we're talking about most first-time buyer programs, no.
Okay. Now, if I'm not a first-time buyer, now what?
If you're not a first-time buyer and you have had credit history, you have been on the job, there's a lot of factors involved. Banks normally look at stability.
Okay.
Stability in the home, stability on the job. You could have 6 months on the job, but have worked in the same field or the same job category, should I say, for many years prior to that.
Right.
So,
Well,
banks look at various factors.
If I've just moved to town, I just got a job, don't have any stability at all, is that going to be a red flag?
Yes.
Is it going to prevent me from buying the car, or is it going to raise my interest rate?
It's probably going to raise the interest rate,
Okay.
but banks do like investments from customers in that situation.
Now, I understand that you operate on interest rates on a scale. Can you share that number with us a little bit? It starts at 0 and then moves to what?
Right. Ford Motor Credit scores off tiers. So when we submit information into the computer, it scores on a tier from 0 to 5.
Okay.
0 being the best, 5 being the worst.
Okay.
And again, factors are involved in that tiering. Factors like, again, stability in the home, stability on the job, how much we're financing, the structure of the deal, so to speak. If someone's putting a great deal of money down, if there's rebates involved, if they have negative equity in their trade, all sorts of factors are involved in that tiering.
You said something that I think we need a definition
Okay.
of, and that would be negative equity. What in the world are you talking?
When you've come in to finance a vehicle and you have a trade-in, and the trade-in has negative equity meaning that you owe more on it than it's worth.
Okay.
Okay? There's a lot of factors involved in that. You could have traded too soon. You could have traded something in on that vehicle prior that had negative equity in it. So all kinds of factors involved.
It could also be that I didn't put enough money down in the deal originally.
That's correct.
And so, and I would imagine that most everybody that finances a vehicle over 36 months, when you got to 48 and 72, etc., I don't know if it goes longer than 72, but most of those folks are going to have negative equity.
That's correct.
Unless they put a great deal of money down.
Right.
What is the typical down payment that you look for?
20% is what the banks like to see.
Okay.
20% of the cash price of the vehicle.
Okay. When you say that's what the banks like to see, does that gives me the most favorable interest rate, etc.?
Well, that does affect the structure and again the tiering with Ford Motor Credit.
Right.
Because it's an investment on the consumer's behalf.
Okay, one of the things that we talk about occasionally is consumers that walk into a credit union and make a deal first before they come into a car dealership. So basically they're a cash buyer, correct?
Correct.
Does that change the dynamic at all?
Not at all.
Really?
It actually saves them time, and consumers know more about financing and about vehicles than they did 20 years ago.
Okay.
So when they come in, a lot of them have done their research, which we appreciate.
Right.
But what we try to do as a dealer, especially here at Don-Chalmers, is if a customer's been to their credit union, chances are we have that relationship with that credit union. And so we try to save them time by taking care of everything here for them.
Okay.
So they don't do their registration paperwork here, go back and do their loan paperwork there, and then come back and bring me a draft. We do everything here at one time for them.
Oh, I see. So you have the relationship with the credit union already, chances are.
That's right.
Okay. Now, is it possible for me to come in with a financing deal and actually find that Ford Motor Credit has a better deal?
We've done that. We've
Really?
actually beat rates with credit unions, with outside lenders, period, with Ford Motor Credit's rates.
But that's probably something I should have done in my research before I ever sit down at this table with you, right?
And not necessarily. We actually help the consumer by bringing them in and showing them what we can do with Ford Credit and what we can do with the credit unions themselves.
Okay.
So we actually have, a way we can show them how to make it better.
Okay. Let's talk a little bit about what actually happens at the closing process, because sometimes that's a little bit confusing. There really is a mountain of paperwork to sign, isn't there?
It seems like that.
What are those forms all about?
Mainly registration. Of course, the lenders have their documents involved.
Right.
With, what's called a spot delivery form. If we contract somebody late in the evening or on weekends and don't have a lender available, then we actually have them sign what's called a spot delivery, and it just shows, look, if the lender comes back and needs something to qualify you for this loan, you are willing to make sure that we get those documents.
And you call that a spot delivery.
Spot delivery.
So I'm walking out with the vehicle, I'm driving it home that night, but I'm going to have to come back and get this deal done.
If the lender requires that.
I got you.
Correct.
I got you. Now, there is a list, I assume, of items that you can add on. What is that? What they call that in the parlance, or not?
We prefer to call them protection items.
Okay. All right. So there are items that you're going to offer the customer. Are there additional fees involved in this?
That's correct.
Okay. Can these fees be financed into the loan?
Absolutely.
So there'll be an impact then on the monthly payment.
That's correct.
Can a consumer get a list of these items with the cost associated with it before they walk into your office?
Absolutely. Normally I am asked in situations like that to go out and speak to the customers ahead of time. Sometimes I have banks come back in and require that a customer has what's called GAP on their loan to protect them and to protect the lender while the vehicle's being financed.
Okay, so GAP insurance, and we've talked about that before, covers that gap in the negative equity thing that we talked about, right?
Correct.
So if I drive off the lot and I owe $30,000 on this vehicle and it's only worth $25,000 and somebody T-bones me and the car's totaled, I don't lose the $5,000.
And nor does the bank.
And nor does the bank. So it protects everybody.
Correct.
Makes sense.
Yes.
Let me come back to this question about finding out before I walk in here. So I can have an idea of what the items are that you're going to talk to me about and what options I'm going to have and what those costs are going to be.
That's correct.
So if I'm doing my homework properly, just follow me through this.
Okay.
I've done a budget. I know what I can afford for that monthly payment. And I don't want to exceed that. So I'm going to have to factor those items in that I believe that I need that you're going to offer me
Right.
into that monthly payment, correct?
Right.
Can you help me do that before we actually get to the closing process?
Absolutely.
Would you suggest that people should do that?
First-time buyers should do that because it does give them an idea rather than, should I say, stress them out when they come into a finance office.
Right.
The one thing that I have learned to do with a first-time buyer, having a young daughter myself, is to go over all of the options, make sure they know what they're signing before they sign, and making sure that they feel comfortable when they come in my office.
Do people bring legal counsel sometimes into your meetings to check these things out?
In 28 years, I've never had that happen.
Really?
But if they did, it would be welcomed.
You'd be comfortable with that?
Absolutely.
I would think so too. It may be that a lot of people understand this process a lot better than I do. But I look at it and think, well, wow, there's some things going on that are happening awfully fast, and I'm trying to make a decision on whether I need this or I don't. So my thoughts are that if I can step back from it and be able to look at it first, as you said,
Right.
well, that makes an absolute lot of sense to me.
Makes it more comfortable.
I think so.
Yes.
Well, let's go through the list, and I assume
Okay.
you're going to share this list with us so we can put it up on our...
I don't have an actual list, but I do have all my options here behind me that we can go over. Absolutely.
Okay, let's talk about what those options are.
Sure.
Well, there's lots of them.
Yes, there are. And we'll just cover the main ones that we do
Okay.
go over, of course. Of course, we have the vehicle service contract because, unlike 20 years ago, people keep vehicles longer than 3 years anymore.
Right.
Well, Ford's bumper-to-bumper warranty is 3 years.
Okay.
And having been in this business for as long as I have, to be honest with you, I wasn't a huge believer in warranties up until about 5 years ago when things became more and more high-tech.
You're talking about extended warranties.
That's correct.
Okay.
That is correct. And what I normally explain to the consumer is, the bumper-to-bumper warranty from Ford is covered 3 year, $36,000,
Right.
and the powertrain is covered 5 year, $60,000.
Okay.
Powertrain meaning your engine, your transmission, and your differential.
Right.
Well, then your standard components like your steering, major brake components, major electrical components like the alternator and such, all of the air conditioning and heating, of course, and all of the high-tech components, those things, say for instance your cruise control, your remote keyless entry, power door locks and windows, those things are covered 3 year, 36.
Right.
Well, we do give the consumer the option to cover up to 6 years or up to 100,000 miles bumper to bumper with those options.
How much more dollars am I talking about here?
There's variances, Skip, because it depends on how many miles are going to be driven on the average per year.
Okay.
But it can range anywhere between, say, 1,500 all the way up to 2,500.
Okay, so that's something that a consumer can consider, look at it and think, am I going to be able to afford to maintain this vehicle beyond the 36,000 miles? And if the answer is no, perhaps you look at one of these options.
Absolutely.
I gotcha. What else is available?
Okay. Then you have the option of the maintenance plan. And Ford actually has a great maintenance plan available, which prepays your maintenance. And
This is different than the extended warranty.
This is what I like to call the what ifs. What if
Okay.
in 4 years from now my AC goes out in my vehicle?
Right.
And this is what I call the have-tos. You have to change your oil. You have to rotate your tires.
Right.
You have to eventually do a brake job on the vehicle.
Sure.
Ford has a maintenance plan available that prepays all of the maintenance for 2 reasons. One, to save you money, because the cost of oil is not going down.
Right.
The cost of labor is definitely not going
Nope.
down. And it also saves you tax because you don't pay tax on the plan, so you're eliminating up to 6 years worth of sales tax on maintenance. But Ford designed it to save you money in the long run.
How long does that plan last?
You actually have the option to do the maintenance for up to 6 years.
Okay, and what's the cost of that?
Just depends on what kind of vehicle because it's different from a gas to a diesel.
Okay.
But it can range anywhere between $17.95 all the way up to $34.95, depending.
$1,795.
Correct.
Okay.
And that's for 6 years worth of maintenance.
Okay.
And again, everything from your oil changes all the way to your fuel filters.
So what somebody's going to have to do then is sit down and do the math.
Correct.
And again, ask themselves the question, am I going to have the income to properly maintain the vehicle, or will I properly maintain the vehicle? Because that's a good question as well. If I have a maintenance schedule and it's already paid for, I'm going to show up. There's no question about
That's right.
that.
That's
but if
right.
I don't, it becomes an option.
Right.
And a lot of young people I know drive the car 10, 12,000 miles before they change the oil and then wonder why the darn thing falls apart.
That's correct.
What else we got?
And then we have what we were discussing earlier is the gap protection.
Right.
Very important. Again, banks like this option, banks and credit unions.
I like the option. I think it makes absolute sense.
It makes a lot of sense. Gap is important because in the event the vehicle is stolen or totaled, if the insurance does not pay what the consumer owes on the loan, Gap comes in and pays the difference.
Well, insurance never pays what the consumer owes on the loan.
Well, I didn't want to say it. I'm glad you did. But that is one thing I do suggest with Gap is, and the one thing about Ford Gap, let me back up a minute. Ford Gap actually pays up to 150% of what that vehicle's worth. Most Gaps pay 110.
Right.
Ford Gap actually pays your deductible up to $1,000 because usually when Gap pays off, the consumer's still responsible for their deductible. Well, Ford Gap comes in and pays that deductible up to $1,000.
Ah,
So the
okay.
consumer walks away owing nothing.
Now, it is true that the consumer can also shop this Gap insurance with their insurance company.
Correct.
And they may find that it is cheaper.
It is
and
less
they-
expensive sometimes with their insurance.
And they may
company.
find it's a better option for them.
Right.
Unfortunately, we have run completely out of time. But
Okay.
if you can just give me, tell me, this is about tire pressure and this is about nitrogen in your tires,
That's right.
Okay. Well, that's an interesting option, but we don't have time to get into
Okay.
it. And the last one is?
Is the credit, life, and disability.
Oh, credit life. That's always an interesting option
Yes.
as well.
Yes.
Definitely. Jackie, thank you so much.
Skip, it's been my pleasure.
It's been an absolute pleasure, ma'am. Thank you.
Thank you.
Isn't this a great car?
This is so cool. It's a really neat old classic car. So was this like your first car or your second car when you were growing
It's
up?
my current car.
Oh, it's your current car. Okay.
That was a great interview, didn't you think?
Very, very neat.
By the way, I got a long-term warranty on this car.
Oh, well, that's good. That's good. There's a lot of stuff to know when it comes to financing a vehicle.
Oh,
and
my gosh.
There's a lot of stuff you should do before. And I think knowing your credit score, knowing what's in your credit report before you go in, because the finance manager is going to find out for you.
Definitely. You can't pull a fast one. You can't say, well, you know, my score should be 800, but it's really 550.
Yeah, you need to know that because they're going to find out real quick.
Well, they are. And you know, what I thought was really important, and I didn't know you could do this, is to get that list of options that are going to be available to you at closing before you ever walk in there.
Know what they're going to offer you because there are a lot of options that the finance department is going to present to you. Some of them might be a good fit, some of them not so much, but you need to do the math on things like the service contract.
Well, you've been
Figure it
through
out.
this, I think, recently, and I know that you told me at one time that you bought some things that perhaps you wished you hadn't.
Right.
Because you weren't prepared.
Well, and I didn't know the details of what it was that I was buying. So if you have that list, like you said beforehand, you know what it is you're buying, you know what it is it's going to cover and what it's not going to cover. Find out if it works for you, find out if you can really afford it, and how much it's going to cost you over the long run.
Yeah, one thing I'd like to say also, I think that before you sign anything that's going to obligate you to a financial payment for a long period of time, it would make some sense to me to have a lawyer look at it.
Yeah, or go with somebody that knows how this works, maybe a dad or a colleague or someone that's been through the car buying process that's familiar with it. They understand some of the terms and the jargon because it is a lot. And I appreciated that the finance department reiterated something that we said, and that's do your homework before. Know what it is you want to buy, know what it is that you can afford, and they appreciate that. The salespeople appreciate that they know what's going on, and then the finance people appreciate that the deal has already been made with the salesperson. Everybody's in the know, you're in the know as a consumer, they appreciate all that.
I like it all. I want to go for a ride?
Let's do it, let's see if it works.
All right.
We'll see you guys right here. Stick with us for the Budget Busters and then Stock Market Corner.
Okay.
This is so cool. I don't think I'm supposed to get in.
No.
Okay. Awesome.
Hi, welcome back. Whew, so little money and so many ways to spend it. This week we're going to talk about the next item in your budget. We all have one, and I'm talking about your cell phone expense. Most of us don't have a landline anymore unless you really need it for the alarm in your house. That'll save you a little money right there, and likely you can spend that money on extra services for your cell phone. As we all know, there are a ton of cell phones and the different calling plans. The plan that you pick will depend on you, your preferences, needs, and probably some of your wants. A word of caution, make sure that you don't buy more phone than you really need or can afford. The smartphones can get expensive and real fast. So there are two factors that you should consider when buying a phone and the subsequent plan. That's unlimited texting and insurance. Yep, I said the I word again. Why an unlimited texting plan? Do I really have to answer that? We text more than we talk. And why insurance? Well, simple, because you'll drop the darn phone more than once and it'll probably break. You'll drop the phone at least into the water once, or someone will drop water on you and your phone. You'll leave it someplace and never see it again. I'm not sure that you can insure the phone against losing it, but you can probably insure it against everything else. It's not all that expensive to buy a new phone when you're under the contract. The bottom line is, insure the darn phone. So, here's some food for thought. You don't necessarily have to buy the phone from the same company that will provide the service. You can buy a refurbished phone. Yes, that means used from a wireless company and pretty cheap. It's possible that you'll find a slightly used iPhone or even a Droid that'll fit into your budget. Since you didn't buy the phone direct from the company, you'll maybe even be able to swing a shorter contract, which will save you money in the event that you have to switch providers. So, whatever you finally decide on, make sure that you keep track of your minutes and the text so that you don't go over. Those overage charges can add up really fast. Happy texting. See you soon.
Hi, and welcome to the Stock Market Corner. I'm Tom Crow.
And I'm Emily New. How's it going, Tom?
It's very well. How are you?
I'm good. I like that we're kind of matching with the red.
We seem to do that.
We're very festive and holiday-ish here in the Stock Market Corner. So how's everything going today? What's going on with the news? What's going on with the markets? There's a lot to talk about.
There is a lot to talk about, and I think since we took a week off, we kind of got a little bit out of the loop in there, and that we talked about Greece in the last segment, and Greece was seeming to straighten itself out, And no sooner did that happen than Italy blows up.
Italy is all over the news now.
Italy's
I can't
all
get
over.
away from it.
Right. Italy's falling into the same trap that Greece was, in that their bond yields spiked up because people are a little bit worried about their ability to pay their debts. And we had another round of discussions in the parliament about whether or not the prime minister was going to stay on. Greece has decided to replace theirs. He stepped down, and his replacement's being sworn in today.
Yeah.
And Italy's Prime Minister Berlusconi has agreed to step down as soon as a finance bailout arrangement deal is made with the
So
European Central Bank. So
Italy's really kind of taken the place of Greece.
Italy's taking the lead,
and
and
they're
that's-
following what Greece did in terms of changing their power structure.
right. And the reason this was even bigger, we had a 3% sell-off in our markets last week because Italy's big enough to matter. We talked about Greece
okay.
being 2% of the whole or the whole European Union. Greece at 2% or 0.5% of the world's GDP. Italy is the third largest country in the EU.
So this
Over
is going to have a
12%.
huge impact.
Over 12% of Europe's GDP comes out of
Holy
Italy.
cow.
So that is, like I say, they're big enough to matter
Right.
and big enough to hurt if something goes really wrong.
And big enough that we're going to feel it even more than we
Oh,
did
yeah.
with Greece. Okay.
Absolutely.
Wow. Kind of crazy. It seems like one thing finishes, then another thing starts, and we just can't get
So
away from it.
there's a lot of moving parts in all this.
Well, what has this done to our markets, and can we attribute anything to what's happening here locally with what's globally? And also, you've said in prior stock market corners that we're also seeing an impact on what's happening with the presidential race and how the markets hate uncertainty. Do you see any of that happening?
Well, certainly Italy did not do anything to decrease uncertainty in the world. And like I said, last week we saw about a 3% sell-off. We had a real rough couple of days in our markets. Trying to bounce back now, I think, because it's looking like there's some more solutions on the table in Europe. But it's going to continue to impact us until this is all straightened out. Now, the big question, like you said, we're in an election cycle now. We've got the debates going on the Republican side. People are talking about how they're going to fix the economy, how they're going to create jobs. As long as we've got uncertainty in the debt side of things, in the bond markets, there's always going to be this just kind of enhanced volatility. The VIX, the thing that we're talking about in the stock market portfolio, which is our measure of volatility and fear in the market, is still way above historical levels. It's still up in the 30s. So it's going to continue to be a rough market, I think. Mid-October through April tends to be a good time to be in the market.
Right.
We may still see a general uptrend, but I think it's going to be a real rocky one.
Yeah, because aren't we assuming that it's going to go up a bit with the holidays approaching
Sure.
and people going out and buying gifts and things like that?
We've got some,
we spend a lot of money now.
We do spend a lot of money this time of year, and we had another improvement in consumer sentiment just today. So it's looking like at least consumers are a little bit encouraged going into the holiday season. Maybe they're going to spend a little bit of money.
Yeah, I mean, we don't spend as much during the summer months typically unless it's for vacations, but come the holidays, even when the economy's a little uncertain and even though we might have some job uncertainty, we still want to spend money and buy gifts.
Kind of starts with the back to school season.
Yeah.
And back to school this year was pretty strong.
Well, that's
so
good.
they're hoping that continues through the end of the year, and we do actually see some real good spending and a little bit of a run up. We've got Apple kind of driving the tech side of things, and their stock has been a little bit weak lately because people are concerned that with jobs being gone, might not see quite the innovative, cutting edge stuff out of Apple that we did before.
Right.
They still look like a really well valued tech company to me, but the market's the market.
And as we've seen before, I mean, it's not just with the loss of Steve Jobs that Apple's is going to completely stop and
Right.
they don't have any other products in the pipeline. I mean, I'm sure he's got plenty of ideas
They
that are
got
going to
plenty of
come to
ideas
fruition.
out there, at least 5 years worth.
And I know that people love to buy those types of gifts for Christmas and for all the people that love all the
They're in a
gadgets
good
and tech
position.
stuff.
Right.
Yeah.
I
So
think
how can we attribute this to what's happening in our portfolio?
In our portfolio, well, we did get stopped out of Abercrombie & Fitch.
So we had our first loss,
They missed
kind
their
of.
earnings and got knocked way out of the park, fell well over 10%, and we sold them at, looks like about a little under $57 a share, and right now they're about 53. So
Okay.
they're continuing to be weak, while some others have come on, some of the more discounters, where we get into our Kohl's, which is our best performer right now, up over 12% right at the moment. Our little high-risk steel company was down, really beat up in last week's sell-off. It's back up over 10% again now, so that tends to be just like we said it would. It's a very volatile stock,
Up and down.
very high risk, but it's going to be a good one if the economy will settle down and we'll get some growth out of this thing. I think we'll do pretty well in that one. Bed Bath & Beyond has pulled back a little bit. It is a little above break even. We're at about a 2% gain. Atmel, the semiconductor one, is also right about break even it got clobbered last week in the whole big sell-off, and it's come back to just about break even. That's another one along the lines of SID, the Brazilian steel company. It's going to just be very volatile.
My prediction, and not that I'm the expert that you are, is that I'm thinking that Bed Bath is going to come up a little bit more again with the holiday season. People buying things. I mean, maybe it's not the most glamorous thing to get some of this kitchen or houseware stuff as opposed to some of the cool gadgets like
Right.
Apple, but people are still buying that stuff.
And the gift card sales. That's another thing to keep in mind. Bed
That's
Bath
true.
& Beyond does a huge business in gift cards where you don't want to go get mom or dad or
Right.
aunt so-and-so the bedspread or the kitchen stuff, but you
Right.
give them the gift card.
They do it themselves.
They do it themselves, and they spend
Okay.
and they usually spend more than is just on the card. So it's always good for the stores that way.
Well, and also a lot of people register at Bed Bath & Beyond for their
Yep.
wedding and things
Sure
like
do.
that. So that might be a good thing that we'll see. That's just my prediction. I don't know. We'll see. But let me just go back to, we're talking about bonds. Bonds are a huge deal, the bonds in Italy. How do we know bonds are going up, bonds are going down? How does that work? How can we kind of navigate that?
Right. We talked a little bit about that in the last segment, that the bond price and yield relationship is inverse. So if a price rises, the yield goes down.
Okay.
And likewise, if the price is driven down, the yield goes up.
Okay.
What happened in Italy? Their bond yield spiked up to over 7%. There was a 10-year bond that went up to 7.5% or something. It's because people were selling their bonds like crazy. They were scared
they're
about
worried.
whether or
Yeah.
not Italy could make good on their bonds, on their obligations to pay the interest and to pay back the bond amount. You're looking at outright default. That's where you don't get anything for what you put in. And if you're looking at a restructuring deal like has been thrown around Greece, where they might get 50 cents on the dollar, all of a sudden you put in $1,000, you're only going to get 500 back. It doesn't matter what they paid you in interest.
Right.
But it all comes down to risk perception. We've talked about how the credit rating agencies downgraded the U.S. They've downgraded European countries. When your rating is downgraded, they're saying you're a higher risk.
Okay.
So in order to borrow money, you're going to have to pay more to incentivize somebody to loan you money.
Yeah, because I might be a little bit apprehensive to give you more money
Sure.
if your credit rating is a little
If,
questionable.
if we were at 5% before. So now let's say I'm riskier, I might have to pay you 10% to get that same amount of money. Just because you're
To give me more incentive,
you're
yeah.
going to want to, and you might, well, if you're going to do a nicely balanced portfolio, you're going to not take so much risk at the far end, unless you just have money to burn, which not many people right now are. I think they're being a little more careful. So the appetite for risk is kind of dried up, and that's the other issue, is that as certain countries or companies, in fact, a little bit off topic, but we had one county in Alabama, municipal bond, actually they declared bankruptcy.
Oh, wow.
So $4 million in a big sewer system, they just got underwater, they couldn't pay it back, and they filed for bankruptcy. So the people that own those municipal bonds
Got
are now
nothing.
getting nothing.
I can't
And
imagine.
for some reason, Alabama seems to do that more often than most. That's a very rare thing for
Yeah.
a city to file for bankruptcy like that.
Right.
But it does happen every once in a while.
Because
So-
typically we think bonds are pretty safe, right? I mean, it seems like more people think a bond is safer of an investment as opposed to getting in the market directly with shares
Right.
and mutual funds. But the bottom line is you have to make sure you know what you're buying.
There's
before
risk
you
in
do it.
everything. Now you compare the Italian bonds; they've pulled back to around 6.5% or so today. But like a U.S. Treasury is still paying down around 2%. So the even though we've been downgraded by S&P, the perception in the U.S. Treasuries is that they're still a good risk.
And we say that the U.S. bonds are backed by, what is it, the full
faith and credit of
Of
the
the
U.S.
US
government, which is the taxpayers.
Right,
So
right.
they're saying that, even though people complain about taxes, they don't like this, they don't like that, they're saying they can always go back to the taxpayers to get more money before they default on a U.S. bond.
There's a whole lot to know here, obviously. This is really interesting stuff and
Lots of moving parts.
lots of stuff happening. And, with what's happening locally, globally, there's always something to talk about. So stay with us. We'll see you guys next week. We'll talk more about this then.
See you next time.
Thanks, guys.
And now, here are this week's questions for classroom discussion. Number 1. What are the minimum qualifications to get an auto loan? Secondly, why is Italy's debt affecting U.S. financial markets? And finally, do you have to buy your cell phone from your service provider?